Good morning, everybody, and thank you very much for logging on to the Forbes Dawson Budget 2021 seminar. Obviously, we'd very much prefer to be there in person and presenting to you in the usual manner, but due to circumstances, this is the best route, really. And there's quite a lot of you logged on today, so thank you very much and welcome. We're going to be talking about the budget 2021. We did think there was going to be quite a lot about capital taxes in the budget, but of course there was nothing, and therefore we're going to be concentrating on the corporation tax increases and the impact that's had on our client base. This is the first corporation tax rise in 47 years, by the way. We're not going to be going into detail about the other changes in the budget. We've actually covered those in our budget top 10, which is available on our website. Plus, it's also very widely publicised, things like the stamp duty land tax extension, the freezing of personal allowances, etc. So as I said, we're going to concentrate very much upon the corporation tax rises and how that impacts our clients and their businesses, and really going to hopefully provide an overview and headline terms of any tax planning strategies or even conversations you should be having with your clients. We are going to be presenting, there's three of us presenting today. Tim Shaw will present on the detail of the corporation tax increases, also losses and the super deduction. Tom Miniken will follow and talk about extraction of profits from the company and the different conversations we need to be having about that. And I will follow on covering any personal tax aspects relating to these corporation tax rises. And then we'll follow at the end with some questions. So please, in the interim, please type your questions in the question and answer box, send them in to us, and we will answer those questions at the end of the presentation. I'll now hand over to Tim Shaw to talk about the CT increases. Thank you.
As Laura mentioned, the main headline measures coming out of the budget were corporation tax rises and some associated measures to deal with losses and incentivisation in terms of additional deductions which are available to companies in the short term. In terms of the headlines, that corporation tax rise is going to kick in from April 2023. And we've got a couple of years before that does kick in. It wasn't a huge surprise of all the leaks that were put out to the press. Corporation tax rises were expected, although most people were expecting a phased approach, whereby maybe a 1% increase per annum over the course of the Parliament. What we actually have is a jump to 25% as from April 2023, so not phased at all. What we do have is the reintroduction of the small profits rate. So we haven't seen this since 2014, where we would have a low profit rate, which used to apply up to 300,000, and then the higher rate used to kick in at 1.5 million. We've got a much lower threshold now, and the high rate of 25% will kick in for profits over 250,000. So we will go back to having a marginal rate similar to the higher and additional rates of income tax. So you'll pay the 19% on your first 50,000 of profit, and then there'll be an effective 26.5% for every pound earned thereafter, such that you are increasing the effective rate of tax on that first 50,000. So by the time you get to 250,000 and above, you're paying 25% tax on your corporate profits. For groups, that marginal band is reduced. The associated companies rule applies again, and there's a change to that associated companies rule, amended a few years back to apply to 51% associated group companies. It's going back to a common control test. So entities under the control of the same person or persons will be associated. You'll need to reduce your marginal band accordingly. There's also the introduction then of the super deduction for capital expenditure, effectively an enhanced first year allowance. So this will apply up until 31st of March 2023, so it won't overlap with the new corporation tax rate. This will give you 130% deduction for capital expenditure on plant and machinery, for example, where previously you would have been applying the 18% per annum rate. And then there's a 50% rate for a deduction where the 6% rate would otherwise have applied on long life assets and cars and so on. And then the final measure on the corporate tax side is an enhanced loss carryback measure. Now, losses we've been able to carry back for up to 12 months. There's no restriction on that loss carryback, and that's now extended to 3 years. So this applies from the current year, so the year to, we have a year end of March, the year to 31st of March 2021. It will also apply to the year to 31st of March 2022. And you can carry losses back up to 2 or 3 years. There is a cap on that carryback, and the cap applies to the year of loss. And the maximum potential tax refund there, if you're able to carry back losses from both the current year and the following year, 2 million for each of those years at 19% gets you a maximum potential tax refund of 760,000. Move on to the next slide, please. So in terms of the corporation tax increase to 25%, well, you know, in simple terms, it means you're paying an extra 6% tax on all of your future profits. But there are ways potentially to mitigate against that headline tax increase. So as companies, groups approach April 2023, particularly in their prior corporation tax period, they'll be thinking about income recognition. So to the extent that it's permissible within UK GAAP or the international GAAP standard that they might be applying, to recognise income early and tax that income at 19%. So things like whether consignment stock and contingent contracts, where you might otherwise not be able to recognise the income until the point when all the conditions are satisfied, maybe looking at those contracts to see if they can be satisfied earlier, recognise and tax the income earlier. Maybe companies could look to postpone decisions on revenue expenditure. So normal expenditure decisions such as that, maybe capital expenditure would be more typical, but certain one-off revenue costs, for example, you know, significant bonuses which might be paid, maybe there's a provision or possibility there to delay those bonuses further and take a deduction after April 2023, when you'd be saving tax at 25%. Of course, it's very possible that we might have some anti-forestalling measures introduced. We've got 2 years for the Chancellor to think about what those might be. But as it stands, thinking about delaying those deductions until the following period. Capital allowances, the regime allows you to disclaim the allowances which you could otherwise claim. And you can then postpone the deduction into the following tax year, so into 2023, and save tax at that higher 25% rate. Of course, we'll talk about a bit more detail about the impact of the loss carryback rule and of the enhanced deduction. So if your enhanced deduction or indeed your capital allowances are generating a loss, you might still want to claim those early and either carry them forward and deduct against tax at 25%, or carry them back for the immediate cash tax benefit now. R&D and patent box regimes. So the benefit, particularly of the patent box regime, brought in 2013 with a 10% rate of tax, when comparing that with a corporate tax rate in the high 20s, was a really significant benefit to patent box. That's been whittled away in recent years as the headline corporation tax rate has reduced back down to 19%. As the rate jumps to 25%, there's a bigger incentive to tax your profits within patent box. So again, companies have got some foresight on that tax increase. They can think about where perhaps they hadn't been patenting processes or products, which perhaps they could look to do going forward and look to take advantage of that patent box regime. Similarly, R&D and the enhanced R&D deduction, which is available. One additional point to note there, of course, is that there was a consultation launched on Wednesday, which is looking at the future suitability of the R&D regime, what expenditure might be included. So over the next 2 years, we'll have a clearer idea of what the R&D regime looks like by the time the new CT rate kicks in. And I've touched on the impact of those super deductions for plant and machinery. If you're generating a loss, you can carry that forward. You can deduct that against your profits, which are taxed at a higher rate going forward. And then the other point to note is owner-managed businesses who will be reconsidering their remuneration strategies and all the various questions around dividend versus salary and the vehicle through which they operate. And Tom and Laura are going to comment further on those considerations in a bit more detail. We'll move on to the next slide, please. So the temporary extension to the trading loss carryback, just to dwell on that for a moment. We've talked about this in a corporate context, but actually it applies to businesses. So it's corporates and unincorporated businesses. So anyone with a trading loss. This is obviously focused on those businesses primarily which have generated losses in this COVID-19 economic environment in which we've been operating. So losses incurred in the current year to March 2021, potentially incurred in the next year. They may be enhanced by the super deductions that are available on plant and machinery. There's a similar trade-off here, it seems, similar to the R&D regime, whereby you can either generate a loss, carry that forward and offset that against corporation tax, currently at 19%, in the future at 25%, or you can carry it back, get some cash back now at a lower rate. And that 19 versus 25 will be the decision that corporates will need to make. I talked about the maximum potential refund available being 760,000. You could alternatively choose not to carry back those losses where you could do. And in that case, that loss is available to shelter tax at a higher rate. So there's a cash flow timing aspect to that decision. I mentioned earlier the super deduction. There's a related impact there because that will increase your losses potentially in the current year and the following year, which will be available to carry back further than they were previously. Can move on to the next slide, please. So if we think back to the current corporation tax rate and how we got to 19%, well, this has been falling since the Conservative government came into power back in 2010. So the international tax landscape at that time saw the UK with a relatively high tax rate, and there was a very relatively common practice of corporates looking to migrate out of the UK, so inversion transactions as they were known. Large groups who would put a new company on top of the group which was located outside of the UK, somewhere like, could have been Ireland or the Netherlands or Switzerland, a number of jurisdictions that offered very low tax rates that enabled the migration of value-adding activities, management and IP holding structures which were situated outside of the UK. Now, as the UK dropped its tax rate over those years, the benefits of shifting a corporate's residence were diminished, and the main driver towards pushing the UK to becoming one of the most attractive holding company regimes, certainly in the G20. Now, the Chancellor announced on Wednesday that our new corporate tax rate would still be the lowest of the G7. That's just about true. The US has a headline rate of 21%, but with the other rates that would apply to corporates in the US, their average comes out at about just above 25. But we're certainly, as a jurisdiction, will be higher than the EU average, which is a headline rate of around 22%. So this puts back on the agenda the marginal rate benefit of recognising income in low tax overseas jurisdictions. So if you think about a typical holding company jurisdiction for an international group, somewhere like Singapore, with a rate around about 17%, 17 versus 19, not a huge differential there between the UK, whereas that jump to 25% means there's a significant benefit to corporates trying to, again, whether it's locating headquarters or value-adding activities outside of the UK. And then that brings back onto the agenda the inversion consideration that I mentioned. So if we think about what we didn't hear about in the budget, which was changes to income tax rates or capital gains tax rates. We are expecting some consultations on those. We won't dwell on those in too greater detail. Let's assume corporation tax rates go up. Capital gains tax rates for shareholders also go up. And we've got a two-pull factor there on owner-managed businesses potentially looking to shift the management and control and the ownership and running of those businesses outside of the UK, looking for a more favourable, lower tax jurisdiction from where they can run their business and minimise the amount of profit which is being generated and recognised in the UK, and then taxed at that higher 25% rate. So that will be an interesting one to focus on going forward, particularly in a post-Brexit world where the UK is trying to incentivise investment back into the UK. Well, to an extent, we've abandoned some of the corporation tax rate lowering measures that were brought in for that purpose in the past. So I expect, particularly around the innovation deductions, which we talked about, the consultation around the R&D, potentially something to see there down the line to try and re-establish the UK as a very attractive jurisdiction for investment and to dissuade corporates from looking to move elsewhere again. And I think I would now pass over to Tom to talk a little bit more about some of the aspects I've talked about there, linked to the deductions and the rate, about managing reward and remuneration strategies.
Thanks for that, Tim. That's been really useful in setting the scene. Obviously, the corporation tax increase was a headline measure in this week's budget. What I'm going to look at now is how that impacts upon owner managers at the point that they want to extract profits from their company. And I think the key point that I want to get across is that this week's budget and the increase that the corporate tax rate going up from April 23 is likely to have is that it significantly influences the decision making for owners of businesses when they want to come and actually take money out of the company. For several years, corporation tax rates have come down. When I started out in tax, the main rate was 28%, and at the moment we're at a rate of 19%. And indeed, many businesses over that period have switched from being unincorporated partnerships, sole traders, into companies with the intention of benefiting from the lower rates of corporation tax. However, over that period, the government has actually increased the rate of tax on dividends. And what I want to get across is that when you combine that with an increase in corporation tax rates from April 2023, it does change the landscape significantly. So on this first slide, I've just tried to illustrate the ways in which an owner-manager of a limited company can pay themselves. Obviously, the two main methods that people are probably most familiar with are salary and dividends, but there are others which I've listed here and in which more interest is likely to be generated. In particular are the options of paying interest. So in many cases, directors, shareholders will have lent money to the company, particularly in the case of new startups or where, say, a previously unincorporated business, and I'm thinking particularly here of buy-to-lets, have been sold to the company in exchange for a loan account. It is possible for the company to pay interest on that loan at a commercial rate. The other alternative is paying rent, and often owner managers will acquire business premises in a personal capacity or through a pension scheme, say, but they say they own it personally, they might not be charging the company any rent. And that's often done because the owner manager didn't want to incur the rates of income tax, or because it would impact upon the ability for them to claim 10% entrepreneurs relief, or as we now call it, business asset disposal relief. That relief, having been curtailed at the last budget, is probably becoming less relevant in the case of people where they're owning premises outside of the company. So it may now be actually attractive to start paying rent at a commercial rate. I will look at some of the other alternatives as we go on. So if we can go on to the next slide. I feel a bit like Chris Whitty at the government presentation saying that, but the next slide explains the factors which we tend to take into account when looking at the ways in which an individual can pay themselves out of their company. The first of these is to consider whether the payment is deductible for corporation tax purposes. Now, obviously, that is not relevant to an unincorporated business such as a partnership, but you'll see that the main difference here is that dividends are not deductible for corporation tax. Now, historically, this wasn't really too much of an issue for two reasons. And the first is that the rates of income tax which apply to dividends are lower than other forms of income, such as salary or paying interest. And the second is that dividends, as you'll see in the second line, don't attract national insurance, whereas, as you can see, paying yourself a salary, or if you're a sole trader or partner in a partnership operating through an unincorporated entity, you do pay national insurance on your trading profits. But the combined effect of those two factors meant that even when you take into account the fact that corporation tax will have been suffered on profits paid out by way of dividend, the individual was still better off taking their money out in this way. And I'll explain this on the next slide, where I've illustrated the different marginal rates of tax that apply to taxpayers, whether they're at basic rate, higher rate, or additional rate, on extracting profits through those four different means. What I've shown here is, well, I've tried to illustrate it with a traffic light system. So where you see the red figures, that's bad, and the green figures are the cheaper ways of extracting profits. So what I'm showing here is if a company, say, makes an additional £100 worth of profit and the individual wants to take it out, this is the marginal rate of tax they will pay. And you can see, as we stand currently, dividends, even with the tax rate increases that were applied, I think in 2016, they are still a cheaper form of taking profits out of a company. But since 2016, it has actually been cheaper to operate as an unincorporated entity, which is the part I've shown an example here as a partnership. So you can see there that you know, a higher rate taxpayer only pays 42% tax operating as an unincorporated entity versus 45 or 49% if they operate as a limited company and remunerate themselves through dividends. Like I say, the main reason for that is the fact that dividend rates were increased in 2016. But if we turn to the next slide, I'll show how this looks following this week's budget. And you'll see that dividends shown in the middle there, those boxes have all started to turn red. And the reason for this is that, as I've said, dividends are not deductible for corporation tax. So now that we have a 6% extra rate of corporation tax, and you combine that with the increases in dividend tax that we've already had, it means that for the majority of our clients who are typically higher or additional rate taxpayers, remunerating yourself through a dividend is now actually more expensive than paying a salary. But before everyone rushes out and puts themselves onto payroll, I will say that this has to be looked at in the round and based on people's individual circumstances. And you can still see that for the basic rate band, there is a significant difference between paying dividends versus paying salary, i.e. dividends are still the best way at those levels to remunerate yourself from the company. And indeed, I think you would have to get to quite significant rates of profit extraction before we'd be saying to people, pay yourself as a salary. But I think the key point is that we should be looking at alternative ways of remunerating ourselves. And the two examples that I've mentioned here are the payment of interest or rent. So where directors' loan accounts are in credit, paying interest is a much cheaper form of extracting profits from a company, or the partnership route, unincorporated route, which I've talked about. Now, if I come on to the next slide, I'll illustrate what I mean by that. Because it's very simple for me to say, switch from a company to a partnership structure. But of course, that's not going to be that straightforward for a business that's already operating and in existence. But we have set up these types of structures in the past, and indeed we're already talking to some of our clients about the things that they could potentially do to restructure things. But essentially what I think people are going to start looking at, and particularly for anyone who's maybe looking at a new business where they're able much more easily to plan, is some form of structure that maybe involves both a company where there is still the benefit of profits, say that the individual doesn't want to take out, being able to accrue at still a relatively cheap rate, 25%. And then potentially some form of partnership structure, say for the management team or the owners, whereby they're able to take the profits out of the business in a form that's much more tax efficient. Unfortunately, with the time constraints, I haven't got the ability to go through that in significant detail. But I certainly think this is going to be a key area for businesses to look at over the next few years. With regards to interest, as I've said, that is a cheaper form of profit extraction. And indeed, an alternative that we're looking at with one particular client at the moment is a reorganization whereby effectively shares that the individuals have in the company are converted into long-term loan notes, where there is the ability for the company to be paying interest, and this is now going to be more tax efficient as an alternative to dividends. So I think, just to summarize, turning to the final slide, with this week's budget having increased the rate of tax on dividends, increased the tax inefficiency of dividends, I think people are going to want to look at alternative methods of extraction, some of which I've talked about, but also I will say, just making sure that people don't forget the simple things like using up dividend exemptions, interest allowances. If you've got other family members who are potentially involved in the business, using their basic rates, things like that, all the quick wins. But then potentially, whilst we've got this 2-year window before the corporation tax increase comes in, maybe considering whether a change in structure is feasible and appropriate. I've mentioned reorganisations involving loan notes potentially being another area to consider. A couple of other alternatives that are, one of which is company car benefits. Historically, we would have said to people, don't hold company cars through the company. But actually, the government last year slashed the rates of benefit in kind on the electric vehicles. You know, if someone was going to buy an electric car with their own money out of after-tax dividends, it's now actually much more efficient for that car to be purchased through the company because the benefit in kind rates are extremely low. Pension contributions, I think, are an often overlooked form of remuneration. The company could make a contribution to directors' pension scheme, so long as it's, you know, reasonable. It should attract corporation tax relief, and there's no national insurance either. And then finally, I think also, you know, individuals who are gearing up for a sale or other form of exit event, you know, with the dividend rates being as they are, you might want to defer that and retain the money in the company and potentially look at, you know, extracting that in capital form at the point you come to exit. On that note, that concludes my slides, and I'm going to pass now to Laura Hutchinson, who's going to talk about some of the wider private client aspects of the budget.
Thank you, Tom. Thank you. As Tom mentioned, I'll be talking about the personal tax aspects, which the budget itself didn't actually directly refer to very many personal tax issues or changes. But of course, as Tom's mentioned, there are significant impacts as a result of these corporation tax increases. And what was conspicuously absent in the budget, which many people expected to be in there, was increases to capital gains tax rates. Many people thought this would happen and in fact brought forward transactions or disposals to pre-3rd of March 2021 to avoid any increase in rates. And now that hasn't happened. And in fact, the Chancellor did announce that the personal tax, the capital gains tax, would stay the same for the next 5 years. So whether that's a throwaway comment to put us off the scent or whether that's actually the capital gains tax regime will stay as it is, we don't know. But we're kind of confident enough to say that we expect that we know changes in the short term. So any disposals that may have been sort of scheduled for before 5th of April could be deferred until after that date, so that basically you have another year to pay any tax liability that arises. Now, I mentioned changes to capital gains tax because, of course, we have had the consultation and we are expecting a response to that on the 23rd of March, I think it is. And of course, we've also had the consultation on simplification of inheritance tax. Now, these have been separated from the budget and obviously we don't know what the result will be, but it's important to note that we do currently have quite a favourable regime for inheritance tax. We obviously understand and know the rules, and it's possible for individuals to give away very large sums, actually limitless amounts of money, without any inheritance tax arising, provided they survive 7 years. Now, that is a very good regime. So we've also got things like business property relief, whereby you can transfer trading company shares into trust without any inheritance tax arising. And along with that, we have capital gains tax holdover to allow you to do that with any capital gains. So we have a very favourable sort of joined up regime at the moment, which we don't know, but may be taken away from us if the simplification of inheritance tax does take place. So as I involve in wealth planning and inheritance tax on a regular basis, I always say, make gifts while you can, do bring them forward if you can afford to do so. It's very much that point now because we just don't know what the regime is going to be in the future. And as Tim and Tom have mentioned, the impact on corporation tax has had on planning that's already been undertaken, things like setting up corporate structures as being a really good regime because of the low rates of corporation tax. That's also impacted on the inheritance tax planning that some people have undertaken very recently. We've been very involved in setting up family investment companies over the last 4 or 5 years. Primarily for inheritance tax mitigation, but one of the bonuses of these structures was this low rate of corporation tax. So this is a structure that allows the family to sort of put a lump sum of cash in, invest that cash for growth for the family members, and allowing that growth to accrue at 19% was very, very favourable. Now, doesn't mean to say that family investment companies are no longer a favourable structure, because, like I said, primarily it is for inheritance tax planning. But of course, it does take away some of those benefits. It's not as low tax as it was. So what can we do with those existing structures now to make them more tax efficient? Well, the first thing I should say is that there's probably two types of family investment company. There's one that's set up to hold property, so residential property or commercial property. And they will continue as before. Basically, they will be subject to these new corporation tax rules if the profits are over £50,000. There are other companies whereby they have stocks and shares, and they will fall into a different regime. They will actually be classed as a close investment holding company. And that's because they hold investments, and they will therefore automatically fall into the higher rates of corporation tax, regardless of the levels of profits arising. So a small company that's realising £40,000 of income on, let's say, interest, then that will be subject to 25% rates of corporation tax from 2023 onwards. So is there anything we can do for those types of companies? Well, first of all, let's not get too alarmed, because a lot of these companies are set up with quite substantial amounts of cash to start off with, so may already fall into the higher rates of corporation tax. The fact that they hold investment portfolios may be irrelevant. They may already have quite significant amounts of profits and therefore be at the marginal rates at least of corporation tax. So what we can do is look at the investments held and think, well, actually, how can we reduce the overall tax rate? Well, as you know, any dividends received by a company are exempt from corporation tax. So it may well be a discussion with the investment manager to say, can we look at investments that primarily produce dividends rather than interest, and therefore you get a lot of the income tax-free. Alternatively, you might consider collective investment funds within that corporate structure, being mindful of certain ones that are actually horrendous in a company, such as investment bonds and some structured products. But things like unit trusts and open-ended investment companies may be a favourable collective fund to have within the corporate structure. The benefit of these is that they hold underlying investments, but the income or the gains arising from the disposal of those investments is not taxable until the actual units in that fund are encashed. So you're not actually saving tax as such, but you are deferring that tax liability until a later date. And the benefit of that, of course, is the tax-free roll-up you get within the structure itself, or low tax roll-up in the structure. You could, of course, consider completely changing the investment strategy in that fund entirely and switching to properties. But that's a major decision to make, and it's unlikely to be one that, you know, people either favour companies, so shares and stocks and shares, or they favour properties. It's kind of inherent in them, so it wouldn't be something I would necessarily recommend. But for tax reasons, if the profits are less than 50,000, then property obviously is more favourable than stocks and shares. And last but not least, in terms of family investment companies, as Tom has mentioned, the fact that when these structures are set up, very often it's mum and dad who put the funds in. Very often they will lend in that money, quite large sums of money. They'll be lent in on repayable on demand terms, and very often interest-free. And the reason historically we've advised interest-free is because mum and dad didn't actually need the income. And that may well still be the case, but if mum and dad were actually holding shares in the family investment company and were previously considering taking dividends out of that company to get their income return, then rather than receiving dividends, it's much better for them to start charging interest on their loans and getting the interest out of the company. As Tom referred to, that interest is deductible in the company, obviously getting the corporation tax relief, and then is chargeable on the person when received. So it's a much cleaner way. It's a much lower rate of tax. So for additional rate taxpayer, 45% rather than the 53% that Tom mentioned before on dividends. So that's something maybe we need to change on some of these structures. We may start charging interest on some of these existing loans. And we might start charging the interest now, even though the corporation tax rates are currently 19%. It may be beneficial to simply accrue the interest in the accounts for a couple of years and then pay that interest, either some of it or all of it, in a later year when the corporation tax rates are higher. being mindful of timing and making sure you're paying it out at the right time. Because of course, don't forget that where these people are connected, there's only a deduction when the interest is physically paid, and obviously it's taxable on that individual. So that's something just to be sort of accruing the interest to make it, you know, a bigger lump sum of interest that can be payable at a later date as and when the company decides to do so. So that's the family investment company. So like I say, I don't think you know, people need to be worrying if they've got one set up. We do have to think about them a little bit differently and maybe sort of switch some investment strategies for tax reasons only. And then lastly, again, looking at companies and looking at more at sort of the areas I'm involved in is lots of property incorporations of existing rental businesses or buy-to-lets. And again, people will be asking, should we incorporate now? Is that something that's beneficial now the rates have gone up? Well, there are different reasons why you would incorporate. One of them is, you know, they might want to get them into a pot so that it's easy to give shares away to family members. They might have a problem with loans, mortgages on these properties, that if they held them personally, they will not get that relief for the mortgage interest, obviously only at basic rates now. So by incorporating and having the loans through the company can get full corporation tax relief for the mortgage interest paid. Also, they may be considering selling some of the properties in the future and therefore want to incorporate under incorporation relief and then sell the properties later on, having obtained an uplift in market value. There's all different reasons, and there might be slightly different conversations we need to have with clients about why they want to incorporate. It might not be as straightforward a decision as before, but it certainly involves some number crunching, in particular around the mortgage interest as well. So again, not a no-go going forward, but just not quite as simple as before. So that sort of concludes my presentation on personal tax. Thank you everyone for attending. Hope you've enjoyed it. What we're going to do now is run through some of the questions that we've received on the specific areas, and we'll obviously read out the questions and then respond to those questions one by one. Thank you.